Unlike Scrooge McDuck, most of the world's richest people don't have all their wealth in a pool of gold, but rather in stocks. But what exactly are stocks? Say you buy one share of Nvidia stock. Congrats, you're officially a partial owner of Nvidia. But this doesn't mean you can walk into Nvidia headquarters and start giving orders. Your percent ownership is extremely small, as there are currently 24.6 billion shares of Nvidia stock. Even Jensen Huang, the CEO of Nvidia, only owns about 3.6% of the company, or about 864 million shares. Okay, but what's so great about owning a fraction of a percent of a company? As a company does well, the stock price will tend to grow as well. So if you make the right investments at the right time, it is possible to grow your investment by unprecedented amounts that you couldn't get in most other investments. But what exactly is determining the stock price? As the company grows, other investors will begin to get FOMO and want a piece of the action. At the same time, some investors who already own the stock may get skittish and think that the current company value may be as good as it gets, choosing to sell their shares instead. The value of the stock will be equivalent to the lowest price a shareholder is willing to sell a stock, and as buyers buy the lowest prices, the share price will rise. As stock prices changes, so does the value of the company itself. By taking the total share count multiplied by the share price, you can calculate the total perceived value of the company, also known as the market cap. So how do people decide which stocks to buy? There are a lot of different metrics that can be used to analyze a stock, but I'm going to focus on some of the most important ones. The earnings per share measures a company's profitability on a per share basis. The price per earnings, or PE ratio, compares a company's current share price to its per share earnings. A high PE ratio may indicate that a stock is overvalued or that investors are expecting high growth rates in the future. Not all stocks will grow as rapidly, so some companies will regularly pay out a dividend or a share of their earnings to their shareholders to keep or attract more shareholders. Many more factors can influence stocks, and it can be difficult for anyone to predict what will happen. While some may get rewarded with an early retirement for knowing to invest in Nvidia back in 2010, others may lose all their money betting big on Blockbuster. To provide more stability, most people will invest in multiple companies. This way, if one company isn't doing well, another company may be doing better, helping to mitigate your losses. One way to safely invest is an ETF. ETFs will track the stock prices of a bunch of companies, providing you a safer mode of investment.